This explainer is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional. Links and resources are available in the description below. All right, let's talk about something big that's happening with mortgage rates. A huge new directive is on the table, and it could affect millions of people. So in this breakdown, we're going to get into what exactly this policy is, how it's supposed to work, and why it's got so many people talking. So where does this all kick off? Right here, with this really direct announcement. We're talking about a clear instruction to two of the biggest players in housing finance, telling them to jump into the market and, well, directly push down borrowing costs for homeowners. And yeah, you heard that right. This wasn't a friendly suggestion, it was an order. And the amount of money we're talking about here, it's just massive. $200 billion. I mean, just let that sink in. A number that big is definitely enough to shake things up in the mortgage bond market. The whole idea, of course, is that it will be enough to push those rates down for pretty much everyone. Okay, so this isn't just some idea being floated for later. Nope. This directive is already happening, and you can bet the markets are paying attention. So let's step back for a second. Why is this happening now? So if you look here, you can see what's been going on. Rates hit that peak, close to 8% a while back. And yeah, they've come down since then, but they've just been stuck, kind of hovering in that 6 to 7% range, and they just won't budge. This new policy, it's basically a direct shot at breaking that logjam and finally getting those rates to move lower, which would obviously make buying a home a little easier on the wallet. Okay, so you might be wondering, how in the world does buying a bunch of bonds actually make my mortgage payment smaller? It sounds complicated, but the basic idea behind it is surprisingly straightforward. It really just boils down to classic supply and demand. Think about it. If a giant buyer suddenly shows up and says, I want to buy $200 billion worth of these mortgage bonds, what happens? Well, demand goes through the roof, right? And when demand skyrockets, the price of those bonds gets pushed way up. Now, here's the crucial part for bonds. Price and interest rates have this inverse relationship. It's like a seesaw. When the price goes up, the yield, which is basically the interest rate, goes down. Now, when we say mortgage bonds, the technical term is a mortgage-backed security, or MBS. And really, all that is a giant bundle. Imagine taking thousands of individual home loans and wrapping them all up together into one big package and then selling that package to an investor. That's an MBS. So this is how it usually works, the standard mortgage pipeline. You go get a mortgage from your bank. But your bank probably doesn't want to hang on to that 30-year loan for, well, 30 years. So they sell it to Fannie Mae or Freddie Mac. They are the ones who bundle it into that MBS we just talked about, and then they sell that to investors. It gets money flowing through the system. But here's the big twist. Now, Fannie and Freddie are being told to be the ones who actually buy these things at the end of the line. They're not just the middleman anymore. So look, trying to lower interest rates, that's not a new idea at all. But how they're doing it this time, well, it's pretty unusual. And frankly, it's raising a lot of eyebrows and some pretty serious questions. And to really get why this is so different, you got to know a little bit about Fannie Mae and Freddie Mac's backstory. Before the 2008 financial crisis, these were shareholder-owned companies, just like any other. But during the crisis, they were on the brink of collapse, so the government had to step in and bail them out. They were put into this special legal status called a conservatorship, and they've been under government control ever since. Okay, so this is where it gets really interesting, because typically when the government wants to push down mortgage rates, there's a different playbook. The Federal Reserve, the central bank, is the one that steps in to buy these mortgage-backed securities. We saw them do it back in 2008 and again in 2020. But this time, the Fed isn't playing ball. They're out. So instead, the government is kind of reaching for a different tool in the toolbox, using Fannie and Freddie to get the job done. And this really starts to blur the lines between different kinds of policy in a way we just haven't seen before. Oh, and by the way, if you find this overview helpful, please consider subscribing to the channel for more concise market updates. As you can probably guess, taking such an unusual step has fired up a pretty big debate. And that's because this move isn't a free lunch. It comes with some very real risks. And that brings us right to the heart of the issue, really the $200 billion question. If Fannie and Freddie go out and buy all these bonds, and then the market turns and the value of those bonds drops, who's left holding the bag? The answer, unfortunately, is pretty simple: the U.S. taxpayer. Remember, because Fannie and Freddie are still in that government conservatorship, they don't have the massive cash reserves a normal private company would have to absorb a big hit. So if things go south, any major losses get socialized. And that's just a fancy way of saying the public, you and me, we end up footing the bill. So this really splits people into two camps. You've got the critics who are saying, whoa, hold on. This messes with the free market. It kicks the can down the road on fixing Fannie and Freddie, and it just gets the government even more tangled up in the housing market. But then you have the supporters, and they're arguing that housing is just too important to let fail. They see a stable mortgage market as a public good, and they believe this kind of direct intervention is exactly what's needed to protect it. So with all that said, what should we be looking for as this policy actually starts to unfold? Okay, let's just recap the big takeaways here. First off, let's be clear, this is a managed market. It's a direct intervention, not the free market doing its thing. Second, the buying has already begun, but they're taking it slow to make sure they don't completely rattle the markets. Third, this whole move is a huge signal. It tells you just how worried policymakers are about these high mortgage rates, and that could be a hint about what they might do in other areas. And finally, while this might help right now, it doesn't really answer those bigger, tougher questions about long-term risk, the government's proper role, and the core problem of housing affordability, which isn't going away. And that leaves us with one last really big question to think about. By using these unique, not quite private, not quite public agencies to do something the central bank wouldn't, have they opened a new door? Does this set a precedent for managing other sensitive parts of the economy down the road? It's definitely something to watch. If this update raised a question or insight for you, you're welcome to share it in the comments. Thanks for watching this video overview on 15 Minute Investor.